Everyone, and welcome to the May Global Market Update. This is Winnie Cisar, Global Head of Strategy at CreditSights, and I will apologize. We are a week later than usual, in part because we like to keep people guessing, and also because our plates have been rather full lately. Zach did a whirlwind trip to DC last week. He did not have a one-on-one with the Commander-in-Chief, but that's okay, maybe next time. And I was making the rounds here in Charlotte, including our annual LevFin Roundtable. Shout out to anyone who attended that. It was a great conversation. Today, per usual, Zach Griffiths, Logan Miller, and I will be discussing all of the recent happenings in the US and Euro markets. And then later, we will bring in the team formerly known as Banks, Peter Simon and Iris Shee, to talk about their recent coverage on BDCs. They launched that this morning. And if you have not yet read their two-part initiation, it is really excellent. Now, before we get into all that, please go ahead and submit any questions that you may have for the strategy team, Peter or Iris. We are always happy to take audience Q&A using that webcast software. But before we start taking questions, we'd like to ask everybody else a question, and that is, what will the Fed's next policy move be? Will it be a hike, a cut, or a prolonged hold, 12 months or longer? I think that today we had a pretty punchy PPI report, and CPI yesterday came in a bit hotter than expected, as did the April payrolls. With that, Treasury yields were initially moving a bit higher, a little bit more of Fed hiking priced into the futures curve, but really not a massive move overall. And so I do think that people are really trying to calibrate how long does this inflationary surge last? What is the magnitude of it? And does it actually change both the Fed and other central banks' stances on monetary policy? All right, it looks like we have a good number of votes submitted, so let's see what the audience has to say about it. All right, this is interesting. Prolonged hold. Almost 80% of the audience thinks that the Fed is going to be on hold for the next 12 months. Like, honestly, that's probably the best case scenario for corporate credit spreads. IG going to 65 in that. Zach, audience thinks that we are on hold for the foreseeable future. What do you make of that view? And how do recent rates market activity and economic data prints influence your own view?
Thanks, Winnie. Definitely interesting to see that. I'd imagine that's quite a bit different than what we would have gotten over the past couple months. And I'd say, in a way, it's consistent with what you're seeing in market pricing. You can look at SOFR futures. Here on the left, we have the latest data as of today, or as of yesterday, I should say. And you can see that there is a material chance of a hike priced in, let's say through early 2027. Overall, looking for yields to kind of remain around where they are today for a prolonged time. So I think there's some interesting movements within the SOFR futures curve, but it's fairly consistent with the view from the audience. And you can see just how much that's changed since year end 2025. You already saw rate cuts pushed out to some extent, but deeper rate cuts anticipated at the end of February, as we saw a little bit more of a true risk off move, with Treasury yields moving lower amid concerns about software before the advent of the Iran war. So we're still in the camp that the Fed could be cutting by the end of this year. I think a prolonged hold certainly makes sense from a risk management perspective. I think the labor market's going to be key. We've had two consecutive better than expected prints there. Jobless claims hovering around 200,000, basically unchanged since late 2021. I'd say the household survey showed some underlying weakness in the labor market, with the unemployment rate rising the most it could without triggering a move in the unrounded figure. And you now have the labor force participation rate at the lowest level since late 2021 at, I think it's 61.8%. So I think the labor market's going to be key. It's understandable given the inflation pressures that we're seeing from the war, that you see chances of a hike being priced. We would fade that move, but understand thinking that that's probably a likely path for the Fed in the near term. The one thing I'd point out that I think is really interesting from a macro perspective and shape of the yield curve is the recent rise in inflation break-evens. You can see in this middle chart here, we've got a lot going on, but considering the move in the 10-year and various key drivers of the 10-year since peak rates in January 14th of 2025 relative to the pre-war and what we're seeing today, the big takeaway is on the far right, you can see break evens at the 10-year part of the curve are up about 24 basis points. And so I think you're seeing more of a wholesale reconsidering how inflation expectations play into longer term yields. And so that's giving us some pause. Ultimately, we do think that adding duration at 4.5% on the 10-year and around 5% on the 30-year will ultimately be attractive, but we don't think that you're necessarily in for near-term price appreciation as we're not looking for a near-term snap lower. But we do think that some of the technicals around these levels probably do not allow for a huge sell-off from here. And I think that's a bit of a contrarian view. We're going to be out with a piece doing a little bit of a deeper dive into that and how to play it. The last thing I'd point out on this slide is just looking at the 10s 30s curve in treasuries on the far right over a very long term time frame. The curve does look fairly steep. Definitely a little bit of angst going all the way out the curve, but I think we're a little bit more comfortable extending duration at these levels as we're not looking for the curve to steepen out of control and yields to sell off too much more from where we are today, barring an additional meaningful shock in energy prices. And Winnie and I were talking about this yesterday, and kind of what I mean by that is maybe a sustained move above 120 or $125 per barrel in Brent. So that's how we're thinking about yields and where the Fed's going and where yields are today.
Great. Thanks, Zach. All right. So Zach is a buyer of duration in the near term with the 10-year treasury hovering close to 4.5%. We would love to hear from the audience. In which market are long duration, so 10 plus year yields, most attractive? Do you like US treasuries close to 4.5%, 10-year gilts at 5.1%, 10-year boons just over 3%, or 10-year JGBs at 2.5-ish%? All right, while the audience is voting, Zach, there's a question from the audience, which I am hoping you can answer, which is how are you thinking about tips and inflation hedged fixed income in the next 12 months?
So you've certainly seen 10-year break evens break out of the range. I think what we've been using as our guidepost for where we're really comfortable adding tips is when the real yield hits 2%. And you saw that earlier this year. Now that you're seeing more of the move in the 10-year nominal yield driven by break evens, I think that creates less opportunity to add, as you've kind of already seen a bit of that move. So overall, I think 2% is kind of our guidepost as like a screaming buy on owning 10-year tips. And I think any kind of bounce around there would be an attractive entry point over the next 12 months.
All right, super helpful, Zach. Let's go ahead and see what the audience is thinking about duration globally. And perhaps not particularly surprisingly, 10-year treasuries at 4.5%-ish are at the top of the heap, though 10-year gilts get a reasonable share at 29%, and then boons and JGBs are lagging overall. So, Logan, I'd be curious to hear from you as rates markets are now pricing in a fairly aggressive hiking cycle for both the ECB and the BOE. Are you a buyer of that hiking trade?
Yeah, thanks, Winnie. Good to be on. So I'd say short message, we are a seller of rate hikes in the near term, which I think obviously runs counter to what's being priced into rate futures markets, especially if you look at the kind of the near term expectations over the next few months. I think today's economic data are quite telling of economic conditions in Europe. We had Q1 GDP confirmed at 0.1%, so very minimal growth. Industrial production for March came in below already low forecasts. And then the employment growth index for Q1 expanded at just 0.1% quarter over quarter. So I think, these figures are very much telling of, what I would consider to be a pretty sluggish economic growth backdrop. So short messages, again, we think it's premature that either the ECB or the Bank of England would hike rates in this environment. Like I mentioned, econ growth is already sort of dismal. I think, rate hikes would probably put Europe at an even worse structural disadvantage. If you look at number one, economic growth that I mentioned relative to the U.S. has been quite slow. If you also just look at, corporate earnings growth over the last, quarter or so, you're seeing a pretty big divergence between U.S. outperforming European earnings for Q1. So, I think that sort of structural disadvantage continues to remain, continues to favor some more of a wait and see approach from sort of the European central banks. I think the biggest question as it relates to, and probably likely driver of rates, is the impact of core inflation over the medium term. I think for that, we can take some clues from 2021 during the previous energy crunch. I think during that period, the fiscal response was quite pronounced as we saw governments really race to support households and companies, which helped to mitigate some of the demand destruction caused by significantly higher energy prices. We think that this period is quite different despite some resemblance to 2022. First, the recent increase in energy prices pale in comparison to 4 years ago when Russia invaded Ukraine. Obviously, the Strait of Hormuz is not the kind of key source of supply for oil and gas for the European economy. Secondly, inflation heading into the 2022 energy surge was already on the rise prior to the energy shock. And so, we're already seeing, headwinds as it relates to U.S. tariffs, slowing exports and supply chain disruptions. We think that in turn, that tells us that domestic demand is likely not going to be strong enough to continue to push up core prices. And then finally, we think the fiscal response is much more limited this time around compared to 2022. You have a number of kind of European countries that have already breached that sort of 3% European Union limit in terms of the fiscal deficit. You have borrowing costs that are hovering near multi-decade highs. So we don't think that the fiscal side is going to be quite as robust this time around, which, I think should keep a lid on how high core inflation goes. I guess the caveat to our sort of wait and see call is that, both central banks, the Bank of England as well as the European Central Bank, were way behind the curve in 2022. They may use this as sort of a way to be proactive rather than reactive. But again, I think what is key for credit markets is I think it's important to consider that government bond yields have really repriced globally. It's not just a Europe or UK development, as shown on the kind of the right hand side of this chart. So we think that the bar is pretty high for another rate shock compared to 2022. Like I mentioned, front end yields have already repriced quite significantly. And so again, short message is that we think it makes sense to sort of fade the move in policy rate expectations based on energy costs alone. And we don't think the kind of reach for yield mantra within European credit is going away anytime soon, even if we do start to see, modest rate hikes materialize, which we can get into some of our, more our positioning calls later on this webinar.
Yeah, absolutely. I think that the difference between hiking from 0 to 5% and from 2.5%, 3.5%, a little bit higher, that's night and day for sure. So across markets in the U.S. and really globally, primary market activity has been, I think, the biggest story for credit investors. We had put out a chart of the day earlier this year, just looking at primary market performance relative to secondaries and USIG, and it is really the place to align with alpha and outperformance. So buying those new issue deals are really important. Now, what is interesting about this year is we're seeing some pretty notable trends. We have an IG market that is on pace for a record-setting year. We have a recent pickup in high yield and broadly syndicated loan supply after February and March kind of negative sentiment dampened the new issue market that really reversed in April. Some of the trends that we are observing, of course, is the continued issuance of hybrids. We actually put out an updated note on corporate hybrids for the US today. So check that out if you haven't. This is a market that has expanded quite significantly just over the past 18 months or so, and it has also outperformed the broader USIG universe. Our utilities analyst, Andy DeVries, is very constructive on hybrids within his space. And of course, we saw Verizon price its first ever two-part US dollar denominated hybrid. Verizon already had existing hybrids in other currencies. Speaking of other currencies, another thing that we have definitely seen this year is many of the hyperscalers issuing in other currencies. We have companies tapping the Swiss franc market, the euro market, the sterling market, and also the yen denominated market. So Google is in the market with some samurai bonds. So that's one thing that I think that a lot of people are paying attention to. This is one of those mixed things where we do note that there is a lot of financing that needs to get done. And so that diversification across currency is positive. There are also a lot of investors outside the US who are looking to get exposure to US tech. But also, it always makes us a little bit nervous when we see such an increase in the share of issuance. In USIG, TMT supply is accounting for almost 40% of non financial issuance, which is definitely a pretty significant uptick. In the high yield market, one thing that we heard quite consistently last week from clients is just the deluge of data center related issuance in US high yield. It accounts for almost 20% of year to date supply. And in April, it was something like 40% of total new issue supply. There's been some, I think, pushback on some of those deal structures, especially as it relates to disclosure and some timing of those deals. And so I think that this is going to be a place where people don't necessarily love the deals, but it is often hard to pass up on the yield. And a lot of them have come in quite large size. In fact, Meridian priced the second largest ever single tranche high yield deal on record at $5.7 billion in April. So, Logan, the primary, I think, has also been pretty robust in Europe, and there's been some interesting structures, a 1,000-year hybrid. How is the euro credit market sentiment holding up amid the heavy new issue supply? And then, does the expectations for a hawkish ECB influence either issuer or investor behavior?
Yeah, I mean, as I wrote on the slide, it's been firing out on all cylinders, especially in May. We've seen a catch up from what was kind of a more moderate April, but May is really off to the races across both investment grade and high yield. In fact, just given the surge we've seen in the last few weeks, year to date supply is now running several percentage points ahead on the Euro IG side. So we're at a new record, just surpassed 300 billion euros for the first time ever this short in the year. High yield issuance is also picking up, and we've actually seen volumes pick up to now more than a third more than they were at this point last year. So definitely quite a large ramp up of new issuance. You mentioned some interesting deals. Yeah, we've saw 1,000-year hybrid bonds. I think that sort of by definition is a bit more of a perpetual type security. Seem to be issued more for kind of regulatory purposes. But yeah, I mean, in general, the spread between issuing a subordinated bond and a senior bond is quite tight by historical standards. You also have that interest deductibility of the corporate hybrid, as well as the equity treatment by the rating agencies as it relates to sort of leverage calculation. So yeah, the environment has been quite favorable for issuers to be issuing more kind of lower rated, lower subordinated securities. And we've also seen, like you mentioned, Winnie, just this continuous wave of reverse Yankee issuance, particularly by the hyperscalers. That's definitely keeping European investors very much glued to their seats in terms of the primary market. Almost 80 billion has priced year to date by U.S. companies and euro-denominated markets, which is setting a new record for the year-to-date supply. We've also seen a pickup in what I would consider to be more discretionary type issuance related to M&A. That's been something closer to 18% of year-to-date volumes across investment grade and high yield. So that's definitely picking up, as well as just the kind of overall backdrop remains really conducive for issuers to continue to borrow. New issue coupons are still pretty attractive by historical standards, even as new issue spreads are exceptionally tight. But I think the demand function is still there for the right price, and so these deals are getting done with very very kind of strong demand. Not seeing much pushback yet, despite kind of this again record wave of issuance year to date.
Yield buyers are still buying the yield. So, on that note, I would be curious to hear from the audience. USIG spreads have held a very narrow range, around 21 basis points year to date. They're now currently trading 77, 78 basis points using the BAML ICE index. Through the end of the year, how will the range in spreads change? Do you think that we're going to break tighter? So, IFG is going below 73 basis points by year end. Are we going to break wider above 94 basis points? Or are we just going to stick in this range? We expect that plus or minus 20 basis point range to persist in the near term. Zach, while the audience is voting, I would be curious to hear how are you starting to recalibrate some of your risk tolerance given the move higher in yields and the expectation that this might be more of a sustained move higher?
It's a great question, Winnie. And I think with all the client calls we've been on and client meetings we've done in person, I've definitely begrudgingly gotten more comfortable with risk. I wouldn't even like phrasing it that way, but I do think that at elevated yields, if you look at what we're seeing in terms of technical, even amid heavy supply, demand seems to be there. 7.75 trillion in money market funds. We already got around 170 billion of inflows in the USIG this year. You can't fight it. And so I think yields are attractive, and that kind of runs the show for now.
I think that the audience is inclined to agree with yields running the show. You want to mute yourself? Sorry, Zach. As they generally expect that this range in IG spreads is going to persist through the end of the year. That is followed by breaking wider. And then we have about 10% of the audience that are in that Goldilocks bullish scenario that IG spreads are going to break tighter by year end. Zach, do you have anything else to say on the IG positioning risk tolerance perspective?
Not really, Winnie. We kind of hit it, just thinking about excess returns flipping quite positive, energy and basics. I think a lot of that is just the uptick in energy prices benefiting the big names in energy and the petrochems and basics. Media is a little wonky on there with Paramount falling to high yield, so I kind of dismiss that. Overall, the curve, spreads up tight. The curve is particularly flat at the back end. And if you look at it on ratings, it's just essentially unchanged, even since year end 2024, except for some blips. So it does seem like the demand is there. Spreads are tight, but that doesn't seem to be driving too much investor concern for enough money.
Fair enough. Within the leverage finance space, we definitely have seen a bit of a repricing. Loans are still discounted relative to US high yield, though that April rally did provide a nice boost both to bonds and then loans kind of followed. Right now, high yield and BSL year to date total returns are neck and neck at about 1.1%. There's been some shifting of places over the course of the year. And in US high yield, really the down the middle strategy has been the winner. Single Bs are up 1.5% year to date. That's just ahead of double Bs, while triple Cs are in negative territory. That's similar to last year when risk on still didn't really fully favor triple Cs and distressed, which I think is both a product of elevated borrowing costs still persisting despite very good access to the primary market, and also the reality that some of the sponsor to sponsor M&A and LBOs are not coming online as anticipated. Now, as in the IG market, media is one of the biggest laggards at the sector level in high yield, as well as technology and transportation, RIP Spirit Airlines. And energy is the big winner this year, up over 4% year to date, which is really quite notable as so many people came into this year expecting a notable oversupply in oil markets. Telecom is a distant second at up 2.7% year to date. Logan, how about within Europe? Does anything stand out as particularly attractive?
Yeah, I mean, I think it really depends on your view on spreads. Obviously, things are kind of back to the tights of the year. We happen to think that valuations are too tight to merit really an overweight positioning in Euro credit. Thus, we have a more neutral view across IG and high yield. We did upgrade our view on Euro high yield after the March repricing to market weight from an underweight. But I think, given our kind of view on rates, that we think, the repricing and expectations for hikes is a bit overdone. We do think that, adding some high quality duration to portfolios makes some sense, especially on the IG side. And we can barbell that with, some kind of higher beta positions in shorter duration bonds. So, for example, we are overweight European utilities on that sort of high quality duration play, further out the curve. And then we would couple that with, an overweight in some of the short duration European autos, which have gotten, a bit hit over the last kind of, couple of months, just given the sort of the cyclicality trade around the Iran situation. But I think liquidity sort of remains solid in the primary market. So finding attractive yield in short-term callable hybrids and financial subs could be another way to sort of generate incremental excess returns without adding meaningful credit risk in IG names with really kind of solid fundamentals. And then for those sort of interested in positioning for a potential shift in consumer behavior, I'd note that we did recently upgrade our view on consumer goods to a market weight, whereas we kept our underweight call on retail leisure. So kind of showing that kind of continued preference for moving up in quality towards your more non-discretionary names versus continuing to be underweight discretionary names.
Great. Thanks, Logan. Lots of moving pieces on the consumer front for sure. We have a lot of conversations with our US consumer team, and confusion reigns given the mix of commentary from different issuers during this earnings season. All right, so that wraps up the strategy portion of the webinar, and we are going to shift to BDCs. Our Banks team, formerly known as Banks team, came out with their initiation on BDCs today, and I would be curious to hear from the audience. In the USIG market, what is the optimal BDC exposure? Do you want to be underweight because you expect persistent spread widening? Neutral weight, there's attractive carry opportunity given wider spreads, elevated yields, or are we going all in, overweight as we expect material outflow generation from BDC issuers in the IG markets? With this, while the audience is voting, I'm going to go ahead and introduce Peter Simon, our head of banks, and Iris G, a senior analyst on the Banks team. You guys have been very, very busy this past month or so between bank earnings and also launching BDC coverage. So Peter, big congratulations to you. Can you give us the too long didn't read version of your initiation? Which BDCs are you covering? What is your official BDC sector rec? And then what was your biggest takeaway from getting up to speed on BDCs?
Sure. Thanks, Winnie. So we put out a two-part report, initiation report on the BDC sector. Part one is framing our sector recommendation, which is an outperform, which we can discuss some of the rationale behind that in a moment. We also have company recommendations. We launched coverage on 5 BDCs in this report. And we're really targeting the largest issuers in the senior unsecured market. Potential to add some more coverage over time, but for now we're covering Ares Capital Corporation, Blackstone Secured Lending Fund, and Blackstone Private Credit, Blue Owl Capital Corporation, and FSKKR. So those collectively, those names. While it's only a small number of the BDCs in the broader universe, accounts for nearly 50% of the bonds outstanding. So in this report, we go over our relative value view for the sector. So some of the key risk themes that have been very relevant recently, as well as deep dives on each of those 5 names that we're launching coverage of and comparison across key metrics. So I think within these, within this group, our top picks, we like Blue Owl and BCRED, which is Blackstone Private Credit Fund. That's largely based on the spread opportunity in those names relative to fundamentals, which we're able to get comfortable with. And we think Ares ARCC is the strongest name on a fundamental basis, but also trades the tightest. So we initiated ARCC with a market perform. But yeah, I mean, I would say, having not looked at these before, we really started this project, kind of end of February, early March, just as the market was really getting very interested, maybe not in a good way, in this space. So my, what I wanted to answer for myself was, a lot of these are investment grade. Should they be investment grade? Is this an investable sector that I can get comfortable with?
given we know, has been on the front pages recently, a lot of the risk factors, and ultimately was able to get comfortable. But that's not saying that we're extremely bullish on fundamentals for the next few years, but there's enough spread to compensate, enough carry to compensate for some of those risks.
Yeah, absolutely. I thought that your report was really great in so many ways. And I think that the audience is a little bit more cautious than you. We have about 53% of the audience saying that they would prefer a neutral weight allocation to BDCs, with 27% underweight and 20% overweight, which honestly, these results are kind of in line with what I would have expected. And that deluge of negative headlines continued today with the Wall Street Journal featuring a report on Blue Owl and just kind of questions around what exactly is in their portfolio. So, Peter, you were mentioning you came out with this constructive view on BDCs, albeit a very nuanced one that you highlight will be with some volatility, and you kind of have to get comfortable holding your nose through some of that. How did you get comfortable? Did your experience with kind of the regional bank crisis in 2023 help with that?
Yeah, no, that's a good point. A lot of it did seem, did kind of remind me of 2023, when where the narrative seemed to get disconnected from fundamentals. A lot of focus on worst case scenarios without much of a focus on what kind of some of the offsetting um, structural protections are in place. I would say that the market in general, I've uh, I've started covering the banks in 2009, so I've been um, I've had quite a bit of time of anything that happens in the financial space that is bad or perceived as risky gets compared to 2008. I think the market just loves a 2008 comparison. Usually they don't really hold water once you dig deeper. So I would kind of put that in this category, while acknowledging that there are challenges to the private credit space and BDCs at the moment. So, in terms of how we got comfortable, I think it comes down to the protections. And again, we're focusing on this space from the standpoint of bondholders. There's very significant protections built in terms of the balance sheet structure of the BDCs themselves, where there is not. I think this might be counterintuitive to outsiders, but not a ton of leverage at the BDCs themselves while they are conducting leverage lending. That debt to equity is usually in the low one range, 1.1, 1.2 range. Um, and then you have ongoing portfolio yields, loan repayments. Um, in some cases, very significant potential support from sponsor companies like a Blackstone or a KKR. Um, and then the funding structure, these are not, there is not a bank run scenario because these are not banks. They're not deposit funded. And we can talk a little bit about that comparison later on. But the access they have to liquidity relative to their near-term debt maturities, looks quite manageable to us as well. So, I think if you're an equity investor in private credit funds or in BDCs, depending on the fund, could be a bumpy ride. There's a range of outcomes, for the next few years. But we really see impairment for bondholders as extremely remote.
Thanks, Peter. That's very helpful. Iris, I want to bring you in to maybe drill down into the fundamentals in a little bit more detail and get some context around the key BDC metrics that you use to assess health and relative value. I think it's really interesting to get both of your perspectives, having covered the banks and BDCs in some ways being like a bank, but as Peter just alluded to, in many ways, very different. So can you walk us through the metrics that matter most to you in your analysis?
Sure, Zach. I think there's a number of metrics that we look at to form a holistic view, but from credit investors' perspective, I think the metrics that matter more are those related to portfolio quality and capital structure. So starting with portfolio construction, diversification is critically important, whether it's by industry, by borrower, and by position. And financial metrics for the portfolio companies are also worth paying close attention to. The size and financial profiles of the companies BDCs invest in. Large BDCs, they disclose portfolio level metrics, including EBITDA growth, leverage, interest coverage, etc. And I would also point to the loan to value ratio at which BDCs lend to these companies, which gives us a sense of the amount of sponsor equity that is beneath credit investors, which will be the first in line to absorb losses, as Peter also mentioned. And in terms of the BDC's own asset quality, non-accrual ratio is the first thing that you look at. But I would say non-accruals only tells you where the issues are already there. So we are also looking for leading indicators of stress, including watch list names and internal risk ratings. But we need to bear in mind that these measures involve some sort of management discretion. Another telling metric is payment in kind income as a percentage of total investment income. There's the distinction as to whether PIK was structured at origination or as a result of amendment. The latter is usually more concerning and signals some credit stress. Also, the collection of PIK income is also a useful metric, but not all BDCs disclose that. And then on capital structure, we focus on leverage and funding. So debt to equity ratio, asset coverage ratio. Also, I think the debt maturity schedule and BDC's funding mix cannot be overlooked either. Lower unsecured debt mix implies a higher level of asset encumbrance, and the amount of unsecured funding is also a factor that flows into rating agencies' assessment. And last but not least, liquidity is the lifeline of a fund. Liquidity sources for BDCs include undrawn bank revolvers and unrestricted cash on hand, and their continued access to capital markets for financing and refinancing needs is also critically important.
That's very helpful. Thanks, Iris. And so we're almost through first quarter earnings season, which has been viewed as much stronger than expected by a wide range of sectors. BDCs bucked that trend of positivity and have a more challenging quarter. Can you take us through some of your takeaways from first quarter 2026 earnings for BDCs from a thematic perspective?
Sure. Zach, I share your observation. I think BDC's first quarter earnings were not too great, but they were not too awful either. So the high level takeaway is that some companies, like most of the companies, they reported softened earnings, largely due to investment yield compression, given lower benchmark rates, and also tightened loan spreads in the recent past. And given this pressure on investment income, dividend coverage has become increasingly compressed. And several BDCs that we cover have announced dividend cuts, including OBDC and FSKKR. Investment activity was quite light in the first quarter. There are a couple of reasons to that. There's seasonality, and also market sentiment around private credit was jittery in the first quarter. Also, the broader macro uncertainty probably has kept borrowers on the sidelines. But as Winnie mentioned, we are seeing a pickup in deal activity starting in April. But on a more positive note, I think these dynamics are prompting a shift in underwriting conditions, nudging underwriting conditions, toward the lender's favor. Lower level of competition in general in direct lending is driving a underwriting reset with, wider loan spreads, lower leverage, and just more lender-friendly credit terms in the market. I think one of the BDCs mentioned that they are seeing around 50 to 70 bp of fees and spread pickup more recently, and around half to a full turn of lower leverage and tighter documentation versus the second half of last year. And realized and unrealized losses also increased sequentially this quarter. unrealized losses made a greater contribution to that, which largely reflected the fair value markdowns on the BDC's portfolio due to unfavorable market conditions rather than any real fundamental impairment. Non-accruals ticked up quarter over quarter, but in general, credit quality remains broadly resilient at the IG-rated BDCs. I think the increase in non-accruals this quarter was mainly driven by isolated pockets of underperforming credits that are facing idiosyncratic challenges, but there were no signs of broad-based credit stress. And shifting to the capital structure, the sector continues to maintain a conservative balance sheet. Leverage ratio ticked modestly up this quarter, but still low in the 1.1 to 1.3 times range. And I would say liquidity sources so far has remained ample.
Thanks, Iris. So, Peter, I'd like to go back to you. We mentioned this a little bit, but you have had the very dubious distinction of covering banks since 2009. So, a lot to unpack there. I hope that you have someone good to talk to you about all of that. But I do think that that gives you some really unique insight into the relationship between banks and BDCs, how banks are different than BDCs, how BDCs may have incremental protections. I would love to hear from you, how do you frame up that BDC risk, especially in the context of the risk of banks?
Yeah, absolutely. I mean, I think that was the framework. I certainly started looking at these with if you look at them compared to banks, if you tried to turn a bank into a BDC or a BDC into a bank, what are the similarities, what are the differences? And I think if certainly if you listen to kind of the tone of market narrative or where spreads were a couple of months ago, you would think that these are clearly much riskier than banks. But when you dig into it, a few interesting things pop up. One is the capital. If you were to analogize the if that's a word, the balance sheets of the BDCs to banks, the capital ratios for the BDCs would be 4 to 5 times higher than for banks. So banks are highly leveraged compared to a BDC. Now the assets are not as risky at a bank, and there's a lot of other protections built in at a bank. But that, in terms of our comfort with the sector, and how certainly I would believe how the rating agencies look at it, that that equity cushion at the fund level is doing a lot of the work here. That you can really absorb very significant losses, and we did some stress testing around that as well, in terms of very draconian loss rates, and you would still have significant. You'd still have asset coverage above 150%. You'd still be that gets to regulatory minimums, but you're still solvent. You're still protected from impairment from a bond perspective. The other major factor, and I think people were seeing the redemption headlines out of the retail funds and trying to, I think where their minds were going were towards a bank run, like a deposit flight, like we saw at SVB or something like that. These are not deposits. This is without getting too in the weeds, these funds do have the ability to gate withdrawals. Typically they allow 5% per quarter. They have the ability to completely gate withdrawals if they need to. But the funding for a BDC is from a mix of long-term senior unsecured or relatively medium duration senior unsecured debt, and revolvers, and so you don't really have the immediate funding risk. So neither of, if you think of what happened in 2023 with some of the banks, you had deposit runs, and because of the deposit run, it exposed an insolvent, underlying bank. You don't really have either risk for a BDC. You don't have the deposit run risk, and we're, given the equity cushion, you don't have a solvency issue. You do have, risky loans, but I don't think that's should be a surprise to anyone. Those, can, certainly can be cyclical. There's, obviously software is worth paying attention to. Um, but and I'm not at all saying that all else equal, I would prefer BDCs over banks, but there's a very significant differential between where the two trade. So it's not as cut and dried of a comparison as I maybe would have expected when I started doing the analysis.
That's really interesting perspective, Peter. And to that end, Iris, from your perspective, how should we be thinking about the recent redemption requests and the implications of these continuing? I know our colleague colleagues on the left fin side love to say that a shrinking BDC is a bad BDC. Is that a big risk that you see for the market as a whole? Kind of frame us up how you're thinking about that going forward.
Yeah, that's a great question. I think it is likely that the non-traded vehicles will continue to see elevated redemption requests in the near term, possibly over the next few quarters, but the magnitude of the pressure will vary by platform. The most exposed vehicles are likely those with higher software concentration and a more retail-oriented investor base, as the retail funds tend to be less sticky and more sensitive to sentiment changes. So theoretically, we think ongoing redemptions could pressure capital inflows and raise the question of long-term platform growth. But in general, we wouldn't expect the trend to become a systemic collapse type of scenario for the large BDCs. So retail capital remains only a minority of total private credit assets, and the bulk of the funding still comes from institutional investors, which tend to be stickier. So in face of ongoing redemption, we expect capping redemptions at 5%, aka gating, to remain the main tool for BDCs to manage liquidity. So gating will likely stay in the news and drag sentiment for a bit. But I would emphasize that gating by itself is not necessarily a sign of stress. It's a structural feature of those closed-end funds to preserve liquidity. Another important point is that non-traded BDCs, they also tend to hold a portion of liquid loans, which could provide an additional liquidity buffer that helps to prevent a fire sale of assets at distressed prices. And for the traded BDCs, we think the negative implications would be fairly limited and mostly sentiment driven. There may be portfolio overlap between the traded and non-traded vehicles within the same sponsor, but so far we have not seen evidence that non-traded BDC redemptions are creating fundamental issues for the traded vehicles. And arguably, lenders with heavy retail funding retrenching, from deal activities could probably reduce competition for the traded ones.
That's very helpful. And along those same lines, have BDCs adequately addressed near-term maturities? Are there any notable issuance trends from BDCs this year that either give you more comfort or are more concerning from your perspective?
Yeah, I think several BDCs we cover came to the market this year and refinanced a portion of their near-term debt maturities, including ARCC, BCRED, BXSL, and LBDC. So these names have issued collectively a total of $4 billion senior debt so far this year, which is against $7.4 billion of scheduled debt maturities over the next 12 months. So I think more refi-driven issuances can be expected. So on the volume front, I would say that issuance volume the first quarter was generally in line, or if not more, if not slightly stronger than the volume we see in the first quarter of 25. But spreads at issuance were notably wider by approximately 50 to 70 bip across these companies. So cost of funding for the BDCs moved notably higher, but still in the, I think they're still in the manageable territory. So just to put it into some context, BCRED priced a 5-year senior bond in April this year at T plus 230 bp. That's 70 bp wider than the 5-year bond it issued in September 2025 at T plus 160 bp. And on the topic of refinancing, we do not expect BDCs to fully refinance upcoming maturities as they have the other funding options. They can draw down bank credit facilities. And for some companies, drawing down revolvers might be a lower cost option than issuing bonds in the public market. But the fact that the BDCs having recently tapped the bond market at reasonable cost speaks to the continued investor appetite for the space, even amid elevated market uncertainty.
That's super helpful, Iris, and actually kind of aligns with one of our audience questions around subscription lines to backstop BDCs and revolving credit facilities. Peter, I'd be curious to hear from you as you were going through Q1 bank earnings. Have there been efforts to try and distance the banks from BDCs, given all of the different headlines around private credit and kind of negative sentiment there? As I know that bank lending to BDCs and other intermediaries has been a pretty significant area of growth.
It has, and I think the tone, it was interesting in first quarter. There was a lot more disclosure, and I think that was in response to a lot of the questions that that the banks are getting from the market on these exposures. Um, Having said that, I didn't hear anything to indicate that they are planning to back away from the space, or that they're overly concerned. I think, our view, and I think the banks share this view, is that the banks are very, very unlikely to have significant losses out of this type of business. I've kind of outlined why I think senior unsecured is unlikely to have losses in most cases. So even more so the case for the secured lines, which have a lot of collateral and a lot of protections in place for the banks. So I think there's a sense that they want to educate the market about this type of business, and I think they hadn't done a great job of that in previous quarters. I think the disclosures are getting better, and I think there's a little bit more granularity around what, when you look at the regulatory filings, what is actually loans to private credit funds versus what is loans to securitization or asset-based finance. So there's more granularity on that case. The takeaway being that not everything that's in the regulatory disclosures as business credit is loans to private credit funds or like BDCs. Some of it is, but it seems to be the minority actually for the large banks. But the other takeaway is that they just, in a broader sense, they don't see problems in private credit as being a systemic issue. I think that aligns with our view as well. I think they're aware that it may go through a cycle. A lot of that depends on the macro environment, but I think they're fairly comfortable with it overall.
Yeah, I think it's been interesting seeing the difference between kind of the headlines and then people who are more familiar with credit cycles and how they're thinking about everything. Somewhat related, we have a question from the audience around the leverage lending guidelines, which kind of capped the leverage points that banks could be involved with, although those guidelines have not really been enforced, I think, since 2018. They were officially repealed recently. Peter, do you think that the recession of those guidelines will push some of these riskier, higher leverage loans back onto bank balance sheets rather than private credit, or is that less of a worry for you?
I think it's a recurring theme here. It's is that it's a nuanced story. I think certainly private credit. A lot of the growth in private credit was driven by um, loans that restrictions on the bank's ability to lend to middle market. Um, a lot of those are being not entirely rolled back, but certainly softened. And the leverage lending guidance being rescinded is a big part of that. Um, we did also get recently updated capital rules, or a proposal at least for updated capital rules. There's some softening in risk weighting for the banks embedded in that. So all in all, there is I'd say directionally more appetite in the future for banks to expand the range of commercial credit that they can hold on the balance sheet. Um, Having said that, I don't, do I think the banks will, go aggressively into sponsor-backed, extremely leveraged software loans on the bank balance sheets? No, because the capital rules are still in place. Stress testing is still in place, and I think they'd much rather just make these very, um, very safe or loss remote loans to the private credit funds than than hold those things on the balance sheet. So I think there's some increase in appetite, but maybe not as much as some might fear.
So not a game changer. Thanks for that, Peter. And not to set us up to maybe wrap up on a little bit less of a positive note, but Iris, we obviously can't have a BDC or private credit conversation without discussing software and the perceived threat of AI to these portfolios. After going through first quarter earnings, where does the software apocalypse, SaaS apocalypse, I guess that is kind of hard to say. I'll just go with software apocalypse, stand in BDC portfolios? What are you monitoring in terms of exposure risk, and maybe where are some opportunities where, the baby's got thrown out of the bathwater on this topic?
Sure. I think software concentration is a legitimate risk factor, but so far, based on what the BDCs reported for first quarter, I would say SaaS apocalypse has not arrived yet. There was not any signs of broad-based AI casualties. There may be one or two software names that BDCs put on non-accrual, where their inability or underinvestment in AI have caused some issues, but broadly, credit quality remains stable. I think the idea of broad-based AI disruption and drastic credit impairment for the BDCs appears to be an overly simplistic narrative. The outlook will likely be nuanced, and I would caution against painting with a broad brush. So software is not just one bucket. There will be dispersion. There will be differentiating factors, including the company's scale, the verticals they serve, the financial strength, and the ability to continue to invest in AI features to remain in the game. So in that regard, what gives us comfort is that large private credit lenders, they focus on financing mature software companies with scale and stable cash flow generation, rather than investing in venture capital style startups that are still burning cash. The BDCs that we cover invest in software companies that generate well above 200 million EBITDA, and they focus on more resilient subverticals where customer relationship tends to be stickier and the cost of switching providers is high. And another fact that cannot be overlooked is that the vast majority of the software portfolio companies are still sponsor-backed, and BDCs lend to these companies at conservative loan-to-value ratio. So in the 40% range, that implies a substantial buffer coming from sponsor equity that protects credit investors. So I guess valuation could compress, but that does not necessarily translate into credit impairments for investors. So overall, I think our take is that software will be nuanced, and the narrative of broad-based credit impairment might be overly pessimistic.
All right. Thank you so much, Iris. With that, I think we have navigated the world of strategy and BDCs pretty well. Just as another plug, if you haven't checked out the BDC launch, the two-part reports, they're really great. So give those a read. We will be hosting an EM webinar on Tuesday, May 26th at 9:30 a.m. London time. So the replay will be available for anyone based in the US. That will be looking at US-Iran war implications for EM economies and financial markets and featuring Regis Chatelier on my team. He's our head of EM sovereign strategy and analysts from the BMI team. Now, thank you all for submitting questions. If you have any follow-ups for me, Zach, Logan, Peter, Iris, reach out using the Ask an Analyst function. And if we didn't get to your question this morning, we will definitely be following up. Thanks for listening. Thanks for tuning in. Stay safe, stay steady. And for any parents in the May-Summer chaos, I see you. For everyone else, we are so close to the summer and hopefully a break from the relentless new issue supply and chaotic headlines. But of course, hope is not a strategy. So be prepared for another a round of chaos because it's probably looming, hopefully not within the BDC sector. And with that, we will wrap up our webinar. Thanks, everyone.